Hello everyone and welcome again to my how-to education channel. As I promised you last week, today we're starting a new topic in finance, working with financial statements part 1. After watching this video, don't forget to leave me your feedback. Financial statements can be used to compare one's firm with the other firms in the market. Nevertheless, it is very complicated to compare two companies because of their differences in size, accounting procedures, locations, target businesses, and time endings. A summer resort and a winter resort, for example, will function at opposite timings. Sometimes, it is actually very difficult to compare different periods of time of the same company. To solve this problem, financial statements should be standardized. This means that the information present in all of the financial statements should be presented in percentages and not in dollars. Examples of these financial statements are called common size balance sheets and common size income statements. The picture aside shows a common-sized balance sheet. A common-sized balance sheet is one that displays all the accounts as a percent of total assets for the current year. If we take cash as an example, cash is $150,000. $150,000 over 8,467,138, which are the total assets, is equal to 0.0177. Thus, 1.77% of total assets are cash. If we now take long-term debt as an example, long-term debt is 4,387,632. 4,387,632 over 8,467,138 equals to 0.5182. Thus, 51.82% of total assets are long-term debt. The picture aside is of a common size income statement. A common size income statement is one that displays all the accounts as a percent of net sales revenues for the current year. Since percentages are ratios themselves, ratio analysis is another way of making comparisons between different sized companies or between different timings of the same company. It is easier than making comparisons using a balance sheet or an income statement. To properly understand each ratio and be able to perform an adequate analysis, some questions must be asked. How this ratio was calculated and in what units of measurement is it expressed? How can it be improved? What is it measuring and why? Is this a good value measurement? There are 5 categories of financial ratios: liquidity ratios, financial leverage ratios, turnover ratios, profitability ratios, and market value ratios. Today, we will go over liquidity ratios and financial leverage ratios. Next week, we're gonna go over turnover ratios, profitability ratios, and market value ratios. From the name, we can conclude that liquidity ratios measure the firm's liquidity and ability to pay its short-term obligations. They usually tackle the current assets and current liabilities. Liquidity ratios include current ratio, quick ratio, net working capital to total assets ratio, and cash ratio. Let's begin with the current ratio. Current ratio equals current assets over current liabilities. To explain this ratio, let's take a numerical example. From the balance sheet in slide 5, we see that current assets are 2,479,793 and current liabilities are 1,340,807. In this case, current ratio is 1.85 times, meaning that there are 1.85 times more current assets than current liabilities. For the people lending money to the firm, the higher the current ratio, the more likely it is that they will lend the money. For the firm, it is important that the current ratio is always greater than 1, or else the net working capital will be either 0 or negative, and the firm will not be able to meet its obligations. Nevertheless, a very high current ratio will not be beneficial as well, since it might mean that the firm is too liquid and is depending too much on the cash from the current assets instead of depending on the operating cash flow to pay the debt. To have a proper idea about how good the value is, the firm must compare it to the other firms. Quick ratio equals current asset minus inventory over current liability. Let's go back to the numerical example. Current asset equal 2,479,793. Current liabilities equal 1,340,807. Inventory equals 1,345,230. In this case, quick ratio equals 2,479,793 minus 1,345,230 over 1,340,807, which is 0.846 times. It is less than half of the current ratio, which means that when inventory was removed, the ratio decreased to less than half of what it was before. This shows that inventory is a very important part of the current assets in this case. Another formula for quick ratio would be quick ratio equals cash plus accounts receivable over current liabilities. Net working capital to total assets equals current asset minus current liability over total asset. The net working capital to total assets ratio measures the net liquid assets of a company as a percent of its total assets. It aims to represent the amount of additional funds available for financing operations as a percentage of the size of the business. In this case, quick ratio equals 2,479,793 minus 1,340,807 over 8,467,138. Thus, quick ratio equals 0.1345. This means that net working capital is 13.45% of the firm's total assets. 13.45% of the firm's total assets are available for financing its operations. Cash ratio equals cash over current liability, which is 150,000 over 1,340,807, which is 0.112 times. This company has a very low amount of cash compared to the current liabilities, which is not the ideal case. Even if the cash has a lower return than fixed assets, a firm must still have a proper amount of liquidity to meet its short-term obligations. That's because the firm needs to pay its obligations within a certain number of days. Low quick and cash ratios are problems to short-term lenders. Another type of financial ratios are the financial leverage ratios, which measure a firm's capability to meet its long-term obligations. The financial leverage ratios can be classified into leverage ratios and coverage ratios. Let's start with the leverage ratios. There are 4 types of leverage ratios: total debt ratio, debt over equity ratio, equity multiplier ratio, and long-term debt ratio. The total debt ratio equals total debt over total assets. Since total debt equals total asset minus total equity, then the total debt ratio can also be written as total asset minus total equity over total asset. Let's give a numerical example based on the previous balance sheet. Total debt equals current liabilities plus long-term liabilities, which are 1,340,807 plus 4,387,632. So, total debt equals 5,728,439. Total assets are current assets plus fixed assets. So, 2,479,793 plus 5,987,345. Thus, total assets are 8,467,138, and the total debt ratio equals 5,728,439 over 8,467,138. Total debt ratio equals 0.677. This means that 67.7% of the firm's assets are financed using debt. The debt over equity ratio equals total debt over total equity, which is equal to 5,728,439 over 2,738,699, which is 2.092 times. This means that the firm makes 2.092 times more debt than equity. Total debt equals debt over equity ratio times equity. If debt over equity ratio is 1, then the firm uses equal amounts of debt and equity to acquire its assets, as in 50% debt and 50% equity. Suppose that the total debt ratio is 0.35. This means that the total debt over total assets equals 0.35. Thus, if total debt is 35,000, the total assets are worth 100,000. Total equity equals total assets minus total debt. So, 100 tau minus 35 tau, which is 65 tau. Therefore, debt over equity ratio equals 35,000 over 65,000, which is 7 over 13. Let's now suppose that the debt over equity ratio is given. Debt over equity equals 0.4. Then, if debt is 40,000, equity will be 100,000, and the total asset, which is total debt plus total equity, will be 140,000. In this case, total debt ratio equals 40,000 over 140,000, which is 2 over 7. The equity multiplier equals total assets over total equity. Since total assets can be written as total debt plus total equity, the equity multiplier can be written as total debt plus total equity over total equity, which is total debt over total equity plus total equity over total equity, which is total debt over total equity plus 1. Total debt over total equity is the debt over equity ratio. So the equity multiplier equals debt over equity ratio plus 1. The debt over equity ratio was 2.092 from the previous slide. So the equity multiplier is 2.092 plus 1, which is 3.092. The equity multiplier measures how many dollars in assets a firm will receive for each $1 that it invests in equity. Long-term debt ratio equals to long-term debt over long-term debt plus total equity, which is 4,387,632 over 4,387,632 plus 2,738,699, which is equal to 0.616. This means that 61.6% of the long-term obligations are liabilities and 38.4% are equity. This ratio is more important to the financial analysts than the ratios concerning current liabilities, since the current liabilities are always changing. Let's now move to the coverage ratios. There are two types of coverage ratios: cash coverage ratio and times interest earned. Times interest earned equals earnings before interest and tax over interest. Let's say that earnings before interest and tax equals 50,000 and interest equals 10,000. In this case, times interest earned equals 50,000 over 10,000, which is 5 times. In other words, what the firm earns is 5 times the amount of interest that it needs to pay, and it will not default on its interest obligations. Cash coverage equals earnings before interest and tax plus depreciation over interest. Let depreciation be $10,000. In this case, cash coverage would be 50,000 plus 10,000 over 10,000, which is 6 times. This ratio is a better measure of the firm's ability to pay interest than the times interest earned ratio, because it includes the depreciation. Since depreciation is a non-cash item that is removed from sales to get earning before interest and tax, a better measure of the firm's interest capability would be to add back the depreciation. Nevertheless, a change in depreciation will not affect cash coverage, since when depreciation changes, earnings before interest and tax will change too. This is it from finance for this week, but if you have reached the end of this video, it is because the content was helpful to you somehow. If this is the case, don't forget to give your friends and acquaintances the opportunity to have access to these videos by liking, sharing, commenting, and subscribing to this channel. We will be continuing with the turnover ratios, profitability ratios, and market value ratios next week. But before that, I will let you know how to sign up for the SAT exam. Thank you so much.